You are listening to the Freight Buyers Club, a home for those interested in international trade, shipping, procurement, logistics, and air freight. In fact, all things supply chain in the Americas, Asia, and beyond. This podcast is brought to you by your host, Mike King, and produced in partnership with Dimerco Express Group, a global 3PL that specializes in managing logistics to, from, and within the Asia-Pacific region.
Hello everybody, welcome to the Freight Buyers Club, which, as you've just heard, is produced with the support of Dimerco Express Group. I'm Mike King, and please do follow this podcast on your platform of choice, including YouTube, where you'll also find loads of additional shorts and news insights. You can also subscribe and listen at www.thefreightbuyersclub.com. Now, today, we have quite a double header lined up for you. After a summer dominated by global sports events, I'll be examining if demand for sports products is aligned with spiking interest in the likes of the Olympics and the Euros. Maybe the new NFL or Premier League seasons will give this vertical a boost. I'm talking to Chris Rogers, Head of Supply Chain Research at S&P Global Market Intelligence. But first up, there's rather a lot going on in container shipping markets, isn't there? And we've got some rather sizable possible disruptions coming down the immediate pipeline from a freight buyer's point of view. So today I'm talking to the Transpacific trade manager of the fifth largest container line by fleet size in the world to get some insight into all of this. He's Senior Director of Trade Management for the Transpacific at Hapag-Lloyd. Torsten Hartmann, welcome to the Freight Buyers Club.
Thank you, Mike. Thanks for having me.
You're very welcome. Torsten, lots to cover today, but first I want to look at a couple of big disruptors for North American shippers. One last month and another that's coming over the horizon very soon. In August, we had a Canada rail worker lockout, and we've got possible strikes on the US East and Gulf Coast ports looming at the start of October. Starting with this Canadian railroad worker lockout, the government has basically ordered operations to restart, and we're watching to see what happens next. There's an appeal from the Teamsters Union about this. A lot of freight moves on the networks of Canadian National Railway and Canadian Pacific Kansas City. It's not just in Canada. How disruptive were these lockdowns in August, and are we still seeing ramifications now for shippers?
I mean, there was definitely some disruption, of course, some planning required to anticipate what would happen, and that we were able to reroute some of the cargo that we had. It has to be said that the situation in the PNW, not only in Vancouver, but also from Tacoma and Seattle, has been difficult for some time. So this was just adding to the problems, and we have seen significant delays over the past many months, primarily due to the rail capacity available out of these Pacific Northwest ports.
Just on that point there, Torsten, is that a rail capacity issue because of demand, or is it because of something else?
It's both due to demand, but it's also due, of course, to allocation of the assets that the railways they have, and they need to serve, of course, many purposes, not only for container shipping, but a lot of domestic services as well. They've had some disruptions with wildfires. They've had some other things that have impacted their operations, and that has meant that over the last few months, we've actually seen quite some disruptions. Tacoma, I think, is a good example. Usually it will work quite well, but if you look at the last few weeks, we've seen very significant delays of operations in and out of Tacoma that were not directly impacted by the Canadian strike.
So things are already stretched. It seems like this could easily flare up again. Are you planning for that possibility?
We are planning for this, but also as we have done in our contingency plans, is that the alternatives are not great, because starting to reroute cargo to different places and rerouting ships and finding available capacity at container terminals and so on is something that is quite difficult in North America. And therefore, once you start moving the big wheels, it will take you quite a long time to get it into action and so on. So addressing this with a strike that may last a few days is something that is very difficult to plan short term. If it was something that was longer term, you could start routing things differently and so on, and customers could change their supply chain plans. But for short disruptive strikes, it's very, very difficult to work around.
And then, of course, you've got to cope with the knock-on effects of that, especially when things are stretched, as you've just described. Another place where things are stretched is US ports. And just some background for our listeners. For an extended period last year and the year before, in fact, we had the threat of strikes and the reality of labor slowdowns at US West Coast ports. An agreement was reached with unions around about a year ago. This year, it's the opposite coast. It's the Eastern Gulf Coast dock workers, represented by the International Longshoremen's Association, the ILA. They're threatening to strike from the end of this month when their current deal with the US Maritime Alliance ends. Pay and conditions are at stake, and the ILA wants a deal that gives its members many of the benefits and outstanding pay that US West Coast dock workers received around this time last year. Obviously, Hapag-Lloyd, I should mention, is a member of USMX, and we would love a scoop were you to explain exactly what that organization is doing in negotiations. But I'll let you answer that part of the question. But I'm mainly interested in the operational elements of this. Now, we know we have a US government mediator come in, but this has been something that we've been looking at coming down the pipeline for a long period of time. What impact has this had on schedules and planning, and maybe also on shipper shipping strategies, if I can put it like that, so far this year?
I think first of all, I think from shipper strategies, I think yes, there's for sure been some consideration as to how to reroute the cargo you've seen, and some of the trade statistics is that the US West Coast volumes have grown quite a bit more than the East Coast volumes this year. If you go back a couple of years, it was the opposite effect when we had the West Coast threat of a strike there. So I think, this is natural that people will start working around, can I find alternative ways to route my cargo in case something happens. In terms of the real negotiation, as you said, this is something that comes around every 5 years, and we need to somehow come to an agreement with the union. Most contentious points is, of course, as we saw on the West Coast, is the issue of pay and the issue of automation of terminals and the protection of work there. So this is something that is being done by what you mentioned, the organization in the US, and they have a direct negotiation now via a mediator with the ILA.
I'll come back to that shift of the cargo from East Coast to West Coast this year, because I think that probably plays into some of the issues you just mentioned with Tacoma and maybe down Long Beach in LA. I'll just give some background for our listeners so that they understand what's at stake here. Using historical data, Sea Intelligence estimates US East Coast handling volumes of 2.3 million TEU in October, which translates into around 74,000 TEU per day. That's 36,000 imports, 30,000 exports. For empties alone, a strike in October would mean the inability to load 20,000 TEU each day. So even a short strike would create massive backlogs, I guess, and global reverberations, would you say?
I would say, I mean, if we were to see a full-blown strike on the whole US East Coast, this will be something that will be very significant in terms of impact to shipping. And there's not really any alternatives to it. I've also been asked, of course, by the management in my company, saying, what's your plan B? And I think the honest answer is that there's no way that you could possibly circumvent if there was a full-blown strike on the US East Coast. It's just so significant, the volume that is being moved there, that you will not be able to work your way around that. I think normally you would say for every day there's a strike, it takes a week to clean up. So that's kind of the rule of thumb that is being used. And of course, the longer the strike is, this could last several weeks to clean up. And in the meantime, of course, ships are stuck, cargo will be stuck, terminals will be unable to operate, and so on. So yes, this could be a very, very significant event if we were to see a full-blown strike.
It strikes me, Torsten, we've had record vessel deliveries across the global container shipping fleet. Like the fleet's up about 10% in a year. But despite this, we've still got these huge increases in spot freight rates. And for those who don't follow container shipping, mostly this is because the Red Sea crisis has sucked in so much extra capacity, because those ship diversions around Southern Africa into Europe and onto the US East Coast just take so much longer. This leaves everything stretched. So this issue on the US East Coast, I mean, you're not really set up as container lines or as Hapag-Lloyd to cope with a major shock to the system like this. Would that be a right way of phrasing it?
Yeah, and I think also primarily it's the infrastructure. I mean, while we can always, produce more ships, and that's a relatively easy process to buy a ship and so on, infrastructure-wise, if you look at all the ports, we see that takes quite a bit longer. And if you look at all the main ports, not only on the East Coast, but also on the West Coast, it's a very long process to expand on capacity. And this is also what we've seen during the pandemic, is that it's not so much that the volume, of course, grows, but the ability of the infrastructure, whether that being railway or that being terminal capacity, is simply not able to keep up with it. So the ability to flex the infrastructure is much more impacting this than actually the actual vessel capacity. just putting in more extra ships does not necessarily provide more capacity in the market. We just kind of, extend the conveyor belt, so to speak, and there's probably more cargo tied up, waiting to go through than the infrastructure in ports and on the rails.
So we've seen those bottlenecks appear most obviously in places like the Med or a bit in Northern Europe, but particularly in Asia, the load ports for the Trans-Pacific. How has that affected US shippers? Because it might seem like a distant problem if you're sat in the Midwest.
It's exactly the same in Asia, and I must say this also, if we look at historically, it's the first time I at least see that almost every port in the world is impacted by delays to capacity, labor. Now of course, we have weather issues as well, typhoons, hurricane season. All these things combined means that it's just, before where maybe in the infrastructure we were working with a little bit of a buffer, so you could recover from a storm, you could take an extra ship in on a day and so on, right? All this buffer is kind of gone because of the increased demand. So now we're seeing that every time there's a disruption, whether that being from weather or that being from additional volumes and so on, it's just the infrastructure is not able to absorb this.
This is always an interesting one for container lines, I find, because obviously these disruptions, there must be a right pain for you to deal with, but the bean counters in your company are actually making lots of money out of it as well. I just wondered what's been happening over the summer. So we've got spot rates into North America from Asia. They're up about 100 to 270%, right? I'm just using those as a guide. I know most cargo into the US is moving on under longer term contracts, but just as a guide, why did things soften over the summer? I'm just trying to work out why these rates have come off a bit.
I think definitely we saw an increased demand. I mean, we see demand both in June and July that are basically matching what we saw back in 21 and 22 during the pandemic. So from a volume perspective, there is a very, very high demand right now. And then with what we just talked about, the infrastructure just does that your ability to push through this extra volume through the system is just limited because we already reached the level of that. So we deploy more ships. There has been more ships deployed. If you look at especially the US West Coast, there's been more capacity, something to the tune of 10% more capacity, around 30,000 TEUs a week, has been added to the capacity on the West Coast. But that has not been able to kind of, satisfy the demand on the coast, and therefore we have seen that rates have increasingly come up. I think also there's a case of some front loading of customers, especially because people have been worried about, we're not going to run into the same issue as we did, years back with the pandemic. So now we want to make sure that we front load a few of the things so that at least we're able to have the supply in place for Thanksgiving and Christmas sales. And I think there has been some amount of that going on over the summer.
It's interesting, isn't it? So you're saying it's we've had an early peak season essentially, but that's been magnified slightly by this drift from the East Coast to the West Coast because of the ILA threat.
Yes, that is true that we have seen that the additional volume is going to the West Coast and more ships have been deployed to the West Coast. So more capacity has also been deployed. It's just the infrastructure ability to absorb this has been not been able to meet that demand.
How's your view on the economy generally? We've got a lot of talk of US recession coming around again. Now, I must say, I've been covering economists saying that there's going to be a US recession for over 2 years. So I'll wait and see till that happens. But you've got your finger on the pulse, so to speak. I mean, how's your view on what demand's looking like when we look a bit further ahead? I mean, the National Retail Federation reported July sales are up in most retail categories. And I think we also saw US imports in June from the Far East were up 14.1% compared to last year. Sits in with what you're saying. Yeah, so how's your general view on where the economy is in terms of short, long, medium term? However you want to answer that, Torsten.
I mean, we look at the unemployment, which is typically a good indicator. I mean, it is still relatively low, while not as low as it was a couple of years back, but still around 4%. I think, as you mentioned, retail sales is still doing well. Most of the big retailers for the second quarter sales were up and actually beating expectations. They all seem to have a fairly positive outlook for the second half of the year as well. So I think from a demand perspective, I think it looks fine. Of course, there's always this issue about, what does higher interest rates do to demand over time? And we definitely also see that one of the things that have changed is that more demand is now being fueled by credit. And of course, eventually people will run out of credit unless you're able to pay this. And I think that is probably the only kind of a little cloud in the horizon is this demand able to be sustained with the current spending that is in the US?
Just going back to your point about front loading because of the threat of ILA strikes, we've got presidential election in November. If, say, there was a Trump administration, I mean, both the Democrats and the Republicans have been pretty protectionist in general on trade, but the Republicans are talking about very big tariff increases, whether that happens or not. Is there any sense that you guys would strategize around maybe there'll be a late year demand surge or an elongated pre-Chinese New Year peak to avoid tariffs if they were looking like they were going to come in early?
I think what we saw from last time, I mean, first of all, a lot of the tariffs that were introduced during the Trump period actually stayed in place. So they were never removed. And we have seen some of the cargo migrating from China to Southeast Asia, especially things like solar panels and that kind of things that were hit by tariffs. Right now, I don't see anybody or any of our customers talking about, the threat of tariffs. I think that's something that is still a little bit distant and something that is not the immediate threat to the business. Over time, of course, that could happen, but I think right now it's not something we're seeing driving people's decisions.
It's not a reason why people might be setting up a few more services into Mexico or anything.
I mean, surprisingly, as you mentioned this about Mexico, I think a lot of people, I mean, are wondering how it could be that Mexico saw this phenomenal growth in volume. And yes, some of it has to do with trying to move nearshore some of the business to the US. Some of it is automotive. So there's a number of industries very much linked to the trade with the US that saw a big surge in the volume. But we still need to think about it from Mexico as a size of the TP trade. It's not even 10% of the trade. So it's a relatively small market compared to the US market.
It might well boom though.
It might very well boom, and I mean, we'll take all the cargo that sails on the seas, whether it goes to the US or Mexico, we don't mind.
um, this is called the Freight Buyers Club podcast. So obviously people are quite interested in pricing. Now, container lines have got a lot of capacity joining the fleet in 2025. We've also had record deliveries this year. Surely this will drag down those prices in the months or in the years ahead. We had Lars Jensen, I'm sure you know, CEO of Vespucci Maritime, leading shipping analyst, on the previous episode, and he predicted that those rates would come down, but not massively, but compared to 2024 levels. Obviously, he threw in the rider that this depends if there's any more shocks to the system. How do you view those opinions?
No, I think it's very true. I mean, every industry, of course, subject to supply and demand, that's something you cannot escape. As we talked about before, I think what has been cushioning things apart from the Red Sea thing, and we have to go south of Africa, is this discussion on the infrastructure, is that no matter how many ships we put in, there are bottlenecks that exist in the market. And no matter how many ships we are able to deploy, we still need to get through the ports. We still need to get through the railways and trucking and all those things, right? So it's a little bit, you can say that just because we can supply more does not mean that we are able to actually push a lot more through the infrastructure. And this, I think, will kind of balance this out, and we will just end up having more ships deployed, but at the same token, there's not equivalent amount of volume actually going through the system.
Thanks, Torsten. If I can just pivot slightly, actually, how would you say that Hapag-Lloyd presents itself to customers, certainly in the US or on the Transpacific trade? And I say customers meaning shippers primarily, but also forwarders. I know is a big part of your customer mix. How would you differentiate yourself to those buyers of freight? Are you still saying that you're a port-to-port service provider?
I mean, we have service offerings, both, of course, ocean as well as also land transport. We're not engaged in logistics in terms of supply chain, warehousing, that kind of things. But we have very good offerings both on the ocean legs, and we are also very capable in taking cargo inland, whether that being to rail ramps or that being to door delivery to customers. That is an integral part of the service that we provide and something that we will continue to provide. We don't go the next step, as some of our competitors have done, and go into more integrated logistics where you tie in the entire supply chain into a service offering. So we think we're better off staying where we are and do what we're good at, and then we leave the rest of it to the logistics partners who are having their expertise in that field.
So that's like an integrated service provider rather than, no, an integral service provider rather than an integrated logistics provider. Would that be the right way to call it?
I think that is the right way, and that's something that also we give the customers the choice of what they want to do. This is what we can offer. If they want something beyond that, of course, there's plenty of other service providers out there who can assist them with some of the additional demands they may have in terms of warehousing, customs clearing, all these other things that can be provided.
Maybe even a future aligned partner. Who knows? We'll come back to that. Hapag-Lloyd Strategy 2030 has 5 pillars, which includes things like investing in more terminals and building up inland transport, as you just alluded to. Are there any firm plans for the US or for the Trans-Pacific trade that you can tell our listeners about now? Maybe some investments.
I mean, we're always looking for interesting investment opportunities, of course. We're a relatively small player in terms of being a terminal operator. We just recently started our terminal division, but we're always on the look for opportunities. Last year, we looked into investing in New York. We were not able to do that because another carrier took that terminal in New York.
Would you go back to New York if an opportunity came up?
I would say New York for sure will remain a very key gateway in North America. So should an opportunity arise there, we would definitely make an effort to do this. Same thing on the West Coast. The thing is that building infrastructure, as we talked about before, has a very, very long time horizon. So from an idea and a greenfield project and so on, it is literally almost decades before you will see something actually being built, right? So that's what makes it very difficult to be a newcomer into the terminal field because basically it's existing structures that you need to invest into. And I think some of the valuations, they went a little bit outside of our appetite, and things may change, and we will see what opportunities comes across, and we will definitely look into that should that be the case.
I guess you'll have some cash available, won't you, after the last year?
Yeah, I mean, we do have some cash available, obviously, and thanks to our shareholders, most of it we send back to them. But obviously, if the right opportunity comes across, I'm very confident that they will also support that, and if they see that this will be a good stepping stone for the company going forward.
Okay, thanks, Torsten. The Gemini Cooperation, I hinted at it a little bit just now. At the start of next year, the 2M alliance between Maersk and MSC ends. MSC goes it alone, and Maersk joins Hapag-Lloyd in a partnership called the Gemini Cooperation. What does this mean on the Trans-Pacific trades for your customers?
What it means on the Trans-Pacific trade is that we're trying to make a new beginning, so to speak. I think a lot of customers over the past many years have seen that we as container carriers, we have continuously not been able to deliver a very good product to our customers. So for a number of reasons, the reliability has just been on the decline for a very, very long time. So we're trying to flip the whole thing around and say, how can we actually provide a better product to customers? So what we are doing is that we're trying to simplify the network that we're operating. So rather than operating a lot of networks that has a lot of ports of call, we're trying to make it into fewer networks with fewer ports of call and then have this hub and spoke concept that we're able to isolate if there's any operational disruptions, and there will be for sure. We're not going to get away with those, but we have built in sufficient buffer into our network that we're able to absorb that so that instead of calling 6 ports in Asia, we may call only 3 ports in Asia and therefore cut down on the friction points, so to speak, and be able to move away around that and then leave some of those things to our shuttles. And the more frequency we have there, we will see actually less delay. If you look at our total volume, 85% of our volume would actually see same or better transit times as it is, even though we are built in the buffers. Of course, there will be ports that we are covering directly today, which in the future will be from a transshipment point of view. We will do our very best to ensure that we can still deliver the 90% that we have set out to do.
I'll come back to the hub and spoke system. Just looking at the service map, so the information I could find, you're going to have 19 ports covered in Asia and 17 in the US on 9 services and using 93 vessels. If that's correct, how does that compare to port coverage now in terms of number of ports serviced? I presume less, and particularly on transit times, because if you're using a hub and spoke system, you're relying on a load of feeder operators. You've got to do transshipment. You've got less direct calls, so it must mean longer transit times.
Actually, it does not mean longer transit times compared to what the actual transit times are today. I think we see a lot of carriers advertising transit times, and then in reality, the actual transit times are significantly longer than what is being advertised. So what we're trying to do is to be up and honest with customers to say, this is how much time it takes to go from this port to this port. But you can now depend on us to do this every week. So when you see a lot of carriers today, including our existing alliance, where we say, well, we have a sailing, but then next week we don't have a sailing because that ship got delayed 4 weeks ago in Asia and so on. What we will be trying to do is that we're saying, yes, it's true. The transit time from Shanghai to LA will be X days. And that's the reality. But what we want to deliver is we want to deliver reliability. So we want to be able that the customer can depend on that every single week we have a service that will take the cargo from this port to that port. And that is, I think, what is important to the customers is whether it takes 14 days or 18 days, that's not so important. But if they can rely on things arriving every Thursday, that's much more important from a supply chain planning perspective.
And you think people are willing to pay for that more reliable service?
I think so, yes. And also, we certainly received a lot of very good interest for the product already. So I'm very confident that we will see some positive coming out of this.
I've interviewed so many shippers, and they always say they always want to pay more for a better service, but they always seem to go for the lower price as well.
Yeah, that is true. I mean, there's always this balance between things and so on. At least we would like to be that if when they have a choice, and of course they have a choice, the customers is that they would go for reliability. Maybe that we have the same pricing, but at least then we will be the first choice because we have a more reliable service, and that's what we're aiming to do.
The reliability promise when Gemini Cooperation was announced was 90% service reliability. As I think that was a promise, but you can clarify. I think in your strategy 2030, it's 80%. But these plans were hatched before the Red Sea crisis, and we've just spent quite a lot of time talking about how stretched liner networks are. Is this even feasible? And just for some background for listeners, most carriers, including Hapag-Lloyd, have for most of the year been operating around about 50 to 60% schedule reliability. I think that's correct.
Yes, that is correct. Is that we're still very, very far away from the 90% that we are talking. So even with the Red Sea crisis, we're not going to compromise on what we will try to achieve in terms of reliability. But of course, as you talked to also, is that the number of ships that we will require to sail south of Africa means that for at least as long as that lasts, we will need to be able to reduce the number of services that we can offer simply because we need more ships to run the services. But the promise or the ambition to try and go to a much more reliable product remains. So it's not like we will compromise on the reliability because we're still sailing south of Africa. We'll try and deliver that, but maybe instead of having 5 services, we will only have 4 services. But we will then invest those ships into making sure that the products that we sail will become as reliable as we possibly can make them.
So there's no rowback on the 80, 90% promise then?
No,
You're not waiting for the Red Sea crisis to be solved?
no, we still set out to do also sailing south of Africa that we still want to deliver that product.
Okay, back to the hub and spoke. Is that a risk for you? I don't know how that works with your suppliers in the US, but I've been covering hub and spoke system for a while. You know, it's only as strong as its weakest partner. How much of that feeder capacity are you going to operate and control yourself? Or do you see that as a risk? You see what I mean?
So we will have a combination of things we operate together with Maersk, as well as feeders and so on that are operated by third parties. But all the most important trunk lines will be operated by ourselves, so that we will be able to control, the schedules of these. In some cases, we're also able to control the hubs. So if you take an example like in Asia, Tanjung Pillar Pass, we're able to control the hub. And Maersk is an owner of that terminal. So we're able to plan things more efficiently and also maybe change the sequence of ships and so on to ensure that the reliability is there. So that's our plan, is that we want to use those areas where we can control things, that we're able to make the difference and make sure that we can actually then deliver a better product.
And is there anything stopping the Gemini Cooperation starting operations at the start of 2025? I think the Federal Maritime Commission, I know this is a bit of a box ticking exercise normally, but they did ask for a bit more information. Are you expecting everything to proceed?
We're definitely expecting everything to proceed. I think this is they're doing their due diligence. They're also responsible to the public in the US. And I think that, that's the process that we follow. And we will, of course, answer any questions they have. I don't see any reason why they should not be able to move ahead as planned.
In a moment, I'll be joined by Chris Rogers, Head of Supply Chain Research at S&P Global Market Intelligence, to discuss just why sports clothing supply chains have been in decline. But let me first say, Torsten Hartmann, Senior Director for Trade Management for the Transpacific at Hapag-Lloyd, thanks for so generously giving us all your time today. It's been very informative and very enjoyable, if I may add.
Thanks very much, Mike. Likewise.
This podcast is proudly produced in partnership with Dimerco Express Group, a trusted provider of global shipping and contract logistics services in Asia, Europe, and North America. Dimerco's particular strength is in Asia, where it gives shippers the freight capacity and local market expertise to streamline freight movements to and from the region, particularly for Transpacific lanes. With 130 forwarding and logistics locations across China, India, and Southeast Asia, Dimerco connects Asia with the world like no other global 3PL. You are listening to the Freight Buyers Club.
Thanks for staying with me, one and all. As promised, I'm now joined by Chris Rogers, Head of Supply Chain Research at S&P Global Market Intelligence. How are you, Chris? Welcome to the Freight Buyers Club.
Thanks for having me along, Mike. It's great to be here.
Chris, just we'll crack on. We've had this dramatic summer of sport. Euro 2024 ended with yet another magnificent failure for us Brits, losing the final again, this time to Spain. This was followed by the Olympics in Paris. We were beaten by Australia in the medal rankings. Very, very sad. Magnificent. Wimbledon, as ever, unless you wanted to support a Brit, deep into week 2. But amid all of this activity and British heartache, S&P put some interesting and quite surprising for me research out in pre-summer, which noted that sport clothing equipment supply chains have been in decline since the pandemic, with US imports dropping from $21 billion in 2021 to $15 billion in 2023. What has been happening to that US import market, and has this continued through the summer, or is it too early to tell?
Yeah, thanks, Mike. As you say, there's been a lot of sports events going on, and you would hope that that would inspire people to get out there, get some new gear and go exercise. I think, unfortunately, what we're seeing is that that's not happening. Clearly, it's a very seasonal business. So a lot of those kind of summer sports clothing, so things like T-shirts and whatnot, were already coming in. So we had a pretty good sense late spring, early summer of what was going on. And, we're looking down 3 to 4% year over year in terms of imports of sports clothing and equipment into the US. A little bit faster rate of decline for clothing and bikes, a bit better for shoes and gym equipment. What's really going on here? And I think, as always, with all of these comparisons for the logistics industry, it depends what you're comparing. It's a very analyst answer, right? Depends when you're comparing with when. But bear in mind, during the pandemic era, people were switching from wearing formal clothes to informal clothes. And that includes things that are classified as sports kit as well. So a little bit, are we comparing the same periods? But the trend has been downwards coming into the summer.
Is this just about the US import market, or is this more of a global issue? How's European demand, for example?
Yeah, so the Europeans didn't have quite such a shocker of a sporting summer as the Brits did. But taking Europe overall, so EU and UK together, actually Europe did a little bit better. So up by a few percentage points. Actually quite a strong result in clothing, so up about 10% in clothing. Footwear kind of flat. I think there's a little bit behind that. I don't think that's all Olympic branded merch. There is probably a little bit of a kick from, excuse the pun, from the football as well going on there. So a lot of that kind of branded, team branded sports clothing may well have picked up as well. So Europe doing a bit better than the US, but it is very much a global issue that we've seen that longer term slowdown in the shipments of sports apparel.
2 questions, I guess, I've got to ask from a logistics perspective. Do we know what any of this means in terms of container or air freight physical volumes? And has any of this trade been impacted by disruptions and bottlenecks? The closure of the Red Sea area being the main, but not the only one, as we heard earlier in this podcast. There's plenty that have been going on through 2024.
Yeah, absolutely. So, the numbers we talked about so far are dollar or euro values. So if you take the inflation element out of that, obviously inflation's been high, but has slowed quite a bit, particularly in apparel. There's not been a lot of pricing power there recently. So actually the change in volumes and value have been pretty close together. So we've seen a slowdown in the volumes being shipped. In terms of that balance of container and air freight, most of the apparel industry, as your listeners know, is slower moving products, so and lower profit margin. So tends to go by sea. I would say that for luxury, fast fashion, and of course the last minute panics of we didn't order enough Spain T-shirts, those do tend to move by air freight, but not as big an element for the industry overall. The industry's absolutely been affected by bottlenecks of all different types. Clearly, for deliveries into Europe and into the east coast of North America, the Suez Canal issues have been significant and ongoing, not just around slowing down shipments, but also raising their costs significantly as well. There's also been congestion in the Asian ports due to weather. European port strike disruptions. I mean, you've talked about this repeatedly, something for everybody. And that's definitely had an impact on the apparel trade. And it's been more significant because it's so seasonal. Your room for error in trying to get stuff in during the spring is really much, much narrower.
Yeah, certainly can't have helped. Do you have any insight, Chris, about how this breaks down in terms of demand by individual sport or sport product?
Yeah, we do. I mean, so for my sins, I triathlon occasionally.
Brave man, brave man.
Yeah, well, I think brave as a ton of bricks is probably the way to put it. But when we look at some of the equipment, the high-end costly equipment has done worse. So bicycles has been a particular part of that. Lots of people bought a new bike during the pandemic, and you don't need a new one very often unless you're a little kid. So that area is done particularly poorly. Imports of swimwear have also done not particularly well either. Not clear what the trend behind that is. We did see a pickup last year, and that was partly around this whole kind of revenge travel thing. So this is more people buying swimwear to go on vacation rather than kind of racing snake equipment to get in the pools. So we have seen that kind of differentiation in there. Where we have seen a bit of a bright spot is in smart bike trainers. So these are the things that you have in your garage or whatever to train up during the winter months. Those have picked up. There's been a couple of product releases that have driven that. And there was also kind of that downturn when Peloton had all of those troubles. And we're now seeing a company called Zwift doing better. So that was a bright spot within an otherwise tough sector.
I read an article the other day. I think it was the CEO of Peloton. He was down to his last 250 million, apparently.
Life's tough, man.
What a
Life's
terrible
tough.
adjustment for him. Okay. On that point, you mentioned you brought in a few different types of products. In terms of trade and how we look at the data, how do we define sport clothing equipment? Do we separate this out, say, from purchases of trainers by new entrants into the trainer market, maybe fashion brands, rather than those traditional sporting companies that we all know, those incumbents? Because in some areas, this is becoming a more fragmented market, as far as, at least from my point of view, looking from outside, I guess, to a degree.
Yeah, so it is difficult to segment the data sometimes. We rely on a broad range of data sets at S&P Global Market Intelligence. Traditionally, trade data uses tariff codes. There isn't a tariff code for bougie, carbon-enhanced sneakers. But there are, as you say, a lot of new brands coming through. For example, I just bought a set of running shoes from a company called True Motion, really small, really new, not quite artisanal. They're still producing in Asia, but that fragmentation is certainly there. And it's a challenge for these smaller companies, right? When shipping times are tough, you're a, 20, 50, 100 TEU company. Wrestling your way onto a boat can be a real challenge, whereas some of the established big companies have less of an issue. It's not to say that the big companies don't have problems, though. You think about some of the issues the likes of Nike or Adidas have had around managing their inventories, whether that's because they've picked dubious partners for their brand or whether they've just ordered the wrong stuff at the wrong time. It is difficult to unpick some of those, but we can certainly segment clothing from shoes. Within the equipment side, we can separate fitness equipment, so things like dumbbells and stuff, from bicycles and smart trainers and so on. So we can segment it, but it is absolutely an industry that's fragmented, as we've seen the emergence and development, particularly on the shoe side of some of these new brands.
On a general level, then, what's the long-term demand outlook for this sprawling sector? Is this a downturn for the industry? Is there something structural going on here, or is some of this a case of inventories being whittled down post-pandemic, when some importers, certainly in the US, seem to have overcompensated for disruptions in the supply chain?
Yeah, I'm not going to use the word bullwhip because that's been wildly overused.
It's definitely been overused. Black swan?
Yeah, last time to use it. No, so I think short term, absolutely, you do have that bullwhip issue, and we had it on the way up and we've had it on the way down. So over ordering, then under ordering. I think what's important to note, though, is that we've been through not just a weird year or weird 3 years for inventories and seasonality. And this year's no different, by the way. It looks like this is an early shipping year to a certain extent. But if we move into next year, into 2025, our global forecast for all trade is for a slowdown in overall growth to around 2 or 3%, which is kind of the long-term average. But if 2025 looks normal, the big question is, what is normal? It'd be the first year since 2016 where we haven't had something like tariffs or a pandemic or recovery from the pandemic or a weird economy or conflict around the world. 2025 could be the first normal year for nearly a decade. I'll believe it when I see it, frankly put. But this is an industry that I think over the longer term, we've seen slow but steady growth. People will still need to wear clothes. People still want branded clothes. And we are seeing, I think, more growth in the emerging markets, so in Latin America and in Asia, than we are in the US and Europe. And that will have an impact for how logistics networks are structured as well.
I couldn't let that mention of tariffs pass, Chris. Obviously, we've got the US elections in November. Donald Trump in particular has been talking about ramping up tariffs, but it's not really just a Republican issue in the US. There's a lot of protectionist talk across the board. How would that possibly play into your idea of normal in 2025?
Yeah, so I guess normal is you've got tariffs, so there you go. What I would say is the issue with tariffs isn't the tariffs themselves, it's the uncertainty that goes with it. A lot of our customers in both logistics and amongst the cargo owners will say, we don't care what policy is, as long as we know what the policy is. It's the uncertainty that really is the killer. And so if we did see continued rhetoric from the Trump campaign around increasing tariffs radically, that might lead companies to say, in December and January, okay, maybe we need to hustle here. As you say, I wouldn't necessarily say that tariffs will disappear should Vice President Harris become the new president. She may continue the Biden administration's current tariff policies. By the way, those tariffs have been increased, and that has driven some shipping into the third and fourth quarter of this year as well. I would challenge the concept, though, that we will definitely have more tariffs in the future. Former President Trump is the arch deal maker, so tariffs will be used as a threat but might not be executed upon. Vice President Harris has talked about the potential to export American values around the world. One way to do that is via free trade deals. So that may bring tariffs down, if anything. We try and be hopeful at S&P Global. So we hope that there will be a breakout of peace and less trade protectionism, but I don't think you necessarily want to bet the farm on it.
We do love an optimist on the Freight Buyers Club, Chris. But Trump has mentioned 65% import tariffs and a universal import tariff across the board, which no doubt would prompt a huge retaliation from the European Union, from wherever. That's a bit different than keeping things as they are, or maybe rowing back as you're hoping that Harris might do.
Yeah, absolutely. And I think an important point on what former President Trump has said is the numbers keep moving, right? So, it's going to be 60% against China. I'm more concerned about what might happen with other countries. As you say, the EU would probably retaliate if a 10% across the board tariff was put in place. I think another area to watch is that the trade deal with Mexico and Canada is due to be renegotiated in 2026. And the tariff threat, particularly against imports from China that go into Mexico, has already been put on the table. So an early renegotiation of the US-Mexico-Canada agreement, as the Americans call it, that's potentially on the cards for 2025 as well.
As you say, yeah, the cargo tends to find a way. And when you have tariffs, it tends to find a different route, as we've possibly seen a bit with Mexico. Is this what China plus one looks like? And if Mexico's winning in that tariff avoidance or production alternative to China, who else is winning? Maybe Vietnam? Where else are you looking at, particularly in terms of sports clothing or sports equipment?
So I think the first point to make is that, reshoring, as we call like all of those things, nearshoring, friendshoring, tariff shoring, whatever, let's call it all reshoring together. That has been a fact of life for a very, very long time. The reason China is a big manufacturing center is because companies move there in the first place. Tariffs are only a small part of the decision. A big part of it is overall cost, particularly labor cost, operational risk. So are you going somewhere that's prone to labor strikes or power cuts? And so that process has led companies to diversify their supply chains. And it certainly goes for the sports apparel supply chains as well. So the plus one for the US when it comes to sports apparel, Vietnam and Mexico, absolutely important there, but also Indonesia and India. When we look at shipments into the EU, China is still more relevant, but we have seen the growth of supplies from Turkey, also from North Africa, particularly Tunisia and Morocco. And what you're seeing there is like a push towards short haul. So we talked a little bit about air freight being used for fast fashion. Well, If you're making it, a few hundred miles away instead of a few thousand miles away, then you can still use short haul sea shipping. And actually, that's a way to get your product to market sooner as well. So throughout that, yes, tariffs are a part of the equation, but I think labor costs, particularly for apparel, which is so labor intensive, I think that's a big part of the equation.
So presumably in terms of long-term logistics demand, then you're seeing more likely to see growth in terms of regional supply chains, those shorter supply chains, than those long east-west supply chains, whether we're talking about ocean or air.
Yeah, absolutely. I think we've had that lesson in a number of industries. And again, particularly for apparel, which generally outside of luxury is lower profit margin. If we don't put out a forecast for long-term shipping rates, but if we're in a $5,000 40-foot world rather than a $1,000 40-foot world, then it just makes sense to ship it less distance. And that reactivity really helps as well. I think overall clothing demand is going to stabilize and grow slowly over time, particularly for supplying some of those emerging markets. But yeah, a move to more regional approaches certainly seems to be a strategy a lot of the firms are following.
Chris Rogers, Head of Supply Chain Research at S&P Global Market Intelligence. Thanks for joining me today on the Freight Buyers Club.
Thanks for having me along, Mike.
We hope you enjoyed this episode of the Freight Buyers Club, produced in partnership with the Dimerco Express Group. Please subscribe and follow on your platform of choice or sign up for delivery to your inbox at thefreightbuyersclub.com. This podcast wouldn't have been possible without the fantastic editing of Karen Ball and Tom Matthews. And finally, thank you all for listening. The next episode will be with you soon.